How do current assets affect balance sheet analysis? Imagine trying to figure out if a company is financially healthy just by looking at its balance sheet. One of the most important parts to examine is the current assets. These are assets that the company expects to turn into cash or use up within 1 year. They include cash and cash equivalents, marketable securities, accounts receivable, inventory, and prepaid expenses. When analyzing a company's balance sheet, current assets tell us a lot about its short-term financial strength. If a company has a lot of current assets compared to its current liabilities, it shows good liquidity. This means it can easily pay its bills and meet short-term obligations without stress. The key measure here is the current ratio, which is current assets divided by current liabilities. A higher current ratio suggests lower financial risk, which is attractive to investors and traders. Current assets also reveal how well the company manages its operations. For example, if accounts receivable are high, it might mean the company is making lots of sales, but it could also mean customers are slow to pay. Inventory levels are another clue. Too much inventory might suggest overstocking or slow sales, which can tie up cash and hurt profitability. On the other hand, low inventory levels might mean efficient stock management or missed sales opportunities. Watching how current assets change over time helps traders see trends. If current assets are steadily growing and liabilities stay controlled, it could mean the company is strengthening its financial position. That might lead to rising stock prices. But if current assets shrink or liquidity ratios fall, it could be a warning sign of trouble ahead. Traders might then decide to avoid the stock or use options strategies to hedge against potential declines. Current assets also influence valuation and risk assessments used in fundamental analysis. Companies with strong current assets are often seen as less risky. This perception can lower implied volatility in options pricing, which affects premiums. When traders understand how current assets impact these metrics, they can make smarter decisions about buying or selling stocks and options. In short, current assets are a snapshot of a company's ability to handle its short-term financial commitments. They help assess liquidity, operational efficiency, and overall financial health. By keeping an eye on these assets and their trends, traders and investors can better gauge a company's market potential and make more informed trading choices.